fill up the family car. So you have to calculate the price of goods and services in terms of gold and silver to truly understand how the dollar is being debased, how you're losing purchasing power by continuing to hang on dollars instead of looking at other alternatives like gold and silver.
What is this fear index that's on your free Gold Money report?
Yeah, what that does is I use it a number of different ways. Basically, I use it as an indicator, whether the trend in gold is up or down. We got a buy signal of the fear index back in May of 2002, and we continue in a buying mode, indicating that the trend for gold continues to go higher. But basically, I use it most importantly for a indication of gold's relative value. And the way it's calculated is I take the gold in Fort Knox, the U.S. gold reserve, determine its market value and divide it by M3, and I get a percent. And it basically says what percent of the U.S. dollar is backed by gold and what percent of the U.S. dollar is backed by debt, because that's basically the rest of the U.S. dollar. When a bank makes a loan, they're creating dollars and they're putting debt on the balance sheet, and that's what's backing the dollar. So it's either gold or debts in government debt or commercial debts on bank balance sheets. Now, historically, it would normally be about 40%. That's what it was typically when the British pound reigned supreme, because you can calculate the fear index for every currency. In other words, it meant that 40% of the paper currency issued by the Bank of England was backed by gold. In the 19th century, as new forms of currency developed, checking accounts and things of that nature, the amount of backing tended to fall, and by the beginning of the 20th century, it was closer to 15% to 20% or so was backed by gold, and the rest was backed by debt. In the 1920s, during the boom, the fear index fell to 10%. In other words, 10% gold backing for the U.S. dollar. During the Depression, it rose back to 38, almost 40%, the dollar backed by gold. And then since then, we've basically been in a long decline. In the early 1970s, the fear index was 1.7%, meaning $1.70 of every $100 of M3 was backed by gold, the rest was backed by debt. The fear index rose to 10% in 1980, and today we're at 2.1%. So the fear index is still relatively low. If the fear index were to go to 10%, as it did in 1980, the gold price would have to increase by about 5 times, and M3 would have to remain unchanged. So on a relative basis, the fear index is still very low, and as fiat currency becomes increasingly doubted, the fear index is going to rise. And the name implies what the fear index does. As people have fear about the purchasing power of national currencies, the fear index rises because the gold price is rising in terms of that currency.
I want to go back. Thank you for answering that. I want to go back to something that confuses me, and if people are paying attention, it may confuse them, which is, when you just a couple of minutes ago, before we talked about the fear index, you were saying, and I'm paraphrasing, basically that an ounce of gold could buy the same ounce of gold for oil. In other words...
an ounce of gold today buys the same number of barrels of crude oil that it could 40 years ago or 50 years ago or even 20 years ago or 10 years ago.
See, I don't understand that. Let me just tell you what I don't understand. And the reason I don't understand it is because if the reserve currency for purchasing oil is the U.S. dollar, how is that possible? It's confusing to me. Could you explain it a little?
Yeah, it's not just oil that has, this consistency, to gold's purchasing power. We look at the price of oil, and in 1950, the price of oil was $1.17 a barrel. Last year it went up to 150, and today it's still around 76 or 7. It's gone back up to 76 or 78 dollars per barrel, and therefore we think that the price of oil is becoming more expensive. But what's really happening is that the purchasing power of the dollar is declining. And that's why I say an ounce of gold buys the same number of barrels of crude oil as it did 10 years ago, 20 years ago, or 50 years ago. There are some small fluctuations, but those are just things that are normal occurrences in terms of supply and demand. So it's that the dollar is losing value, and in order to truly understand what's happening to the dollar, you have to calculate the price of goods and services in terms of gold. Now, and not only tangible assets like gold, like crude oil, but also financial assets can be calculated in terms of gold. And one of the things I like to do is look at the price of the Dow Jones Industrials in terms of gold.
Explain what that is. Explain what the Dow Jones Industrial is to the common person.
Well, the Dow Jones Industrial Average, we normally think of it in terms of dollars, and it's $10,000 or $14,000 or whatever the number, $10,000 or $14,000 on the Dow. That's basically a dollar, calculation. But what we can do is we can go back throughout history and find out, what the dollar gold exchange rate was, and then determine what the Dow Jones Industrial actually was in terms of gold. And back in the 1930s, the Dow at its low was 35, and an ounce of gold was 35. So there was this one-to-one relationship between the Dow and the gold, which was the exact opposite of where it was in 1929. It took over 20 ounces of gold to equal the Dow Jones Industrials. Then in 1968, it took 35 ounces of gold to equal the Dow Jones Industrials, or approximately 35. But by 1980, the Dow was 800 and gold was 800. So you came back to this one-to-one relationship. 1 ounce of gold equaled the Dow. In 2000, it took 42 ounces of gold to equal the Dow Jones, giving an indication of how overvalued stocks were and how undervalued gold was. And today it still takes about 9 or 10 ounces of gold to equal the Dow, depending on what day it is and of the week, and whether the Dow's up or down, and whether gold's up or down at that moment in time. But at some point in time in the future, I think we're going to see the end of this boom-bust cycle, where 1 ounce of gold again equals to the Dow. In fact, I was interviewed back in October of 2003 when gold was around $340, $350 an ounce. I was interviewed by Barron's, the financial newspaper in the States, and they asked me to project the price of gold, and I used this comparison, and I said we have two previous boom-bust cycles. At the end of those previous boom-bust cycles in the 1930s and in 1980, 1 ounce of gold equaled the Dow, and I said it's going to probably take 10 to 12 years. So this was 2003, so I was saying 2013 to 2015 for this next bust to end. And when it does end, 1 ounce of gold will equal the Dow. And they said, well, that's interesting, but put a dollar price on it. And I said, you can't really predict a dollar price because it depends whether the Federal Reserve inflates or deflates. They said, well, take a guess. And I said, well, the history of the Federal Reserve is basically one of inflation, so they're probably going to inflate. So I said to Barron's that in 2013 or 2015, 1 ounce of gold will equal the Dow will be 8,000, and gold will be 8,000. Now, it sounds outrageous, but if you remember back in October 2003, gold was about $350, 10 times more than it was when it was $35 in 1971. But it took $10 in October 2003 to purchase what $1 purchased in 1971. So gold in 1971 went from $35 to $800 by 1980. So I was basically saying that the dollar, which had only 1/10 of the purchasing power that it did back in the 70s, was going to take gold from $350 to $8,000. I was basically saying that history was going to repeat. But basically, given what's happened in the Federal Reserve since then, and particularly in the last couple of years, I think my upside forecast for the gold price is too conservative, and I think we're going to see a gold price over $8,000 because I think the U.S. dollar is very, very close to hyperinflation.
Explain what that is.
Well, hyperinflation basically means a very rapid increase in the money supply, a very rapid decrease in the demand for currency, and it essentially translates or manifests itself as rapidly rising prices. And when we talk about hyperinflation, there's a lot of misconception. People look at Weimar Germany in the 1920s and they see, people moving paper currency around by wheelbarrows and bushel baskets, or they look at what happened in Zimbabwe more recently and the terrible hyperinflation that that country had. And that's one kind of hyperinflation. It's a paper currency hyperinflation. But Argentina and other Latin American countries in the 1980s and early 1990s had a different type of hyperinflation. They had a deposit currency hyperinflation.